Hello friends, welcome to my channel Finance Eco India. So today we'll be discussing about the idea of building a 100 crore portfolio, which sounds like a fantasy. It's the kind of number you hear about in business headlines, not in your own financial plan. But what if it isn't? What if it's not a matter of luck or a secret formula, but a strategic long-term project of discipline and patience? In this video, we are going to break down the exact blueprint you need to build a 9-figure portfolio. We will go beyond the hype and get into the real, actionable steps, from the math of compounding to the psychological mastery required to navigating the markets. Our journey is built on 4 core pillars. First, we will establish the non-negotiable foundation of wealth creation. Second, we will explore the strategic investment philosophies that can guide your decisions. Third, we will detail the practical numerical roadmap to your goal. And finally, we will talk about the human element, the most critical variable in this entire. This is not a get-rich-quick scheme. This is a strategic blueprint for a legacy. Let's begin. The foundational principle of generational wealth. Every great structure needs a rock-solid foundation. In the world of wealth creation, that foundation is built on two simple yet profound principles: compounding and discipline. Let's start with what Albert Einstein reportedly called the eighth wonder of the world: compounding. At its core, compounding is simple. It's earning interest on interest. Your investment earns a return, and that return is then reinvested to generate its own returns. This creates a snowball effect where your wealth grows not linearly but exponentially, especially over a long period. The mathematical principle is captured in the formula A is equal to P 1 plus R by N power to T. A is your final amount, P is your initial principal, R is your annual rate of return, and T is the number of years. The most important part of that formula is T, or time. Time is the engine of compounding. A small investment can grow into a significant amount of wealth, but only if you give it enough time to work its magic. Consider this powerful illustration. We have two investors. The early investor starts at age 20, investing just 200 per month for 40 years. The late investor waits until they are 40, but invests a high amount, 400 per month for 20 years. Both invest a total of 96,000, but by age 60, the early investor has accumulated an additional 86,676 compounded to the late investor, simply because their money had more time to compound. This is the most critical lesson of wealth creation. The most important decision is not what you invest in, but when you start. The answer is always today. Beyond the math, the single most important factor is your mindset. Journey to 100 crore is a psychological one. You have to shift from a saver to a creator. This begins with a principle that seems almost too simple. Spend less than what you make and invest the difference. Consistently living below your means create a surplus of capital that directly fuels the compounding engine. It allows you to develop healthy investment habits and formalize a clear written plan. This plan is your guide. It helps you make rational decisions and avoid costly emotional mistakes. Let's put this into perspective with some numbers. Imagine you have a 1 crore lump sum to invest. If you let it grow at 12% annual return, it would have about 41 years to reach 100 crore. That's a long time. But if you supplement that lump sum with a disciplined multi-systematic investment plan or SIP of 1.5 lakh, you could reach your goal around 32 years, saving off a full 9 years from your journey. This significant acceleration is the tangible reward for your discipline and consistency. The architectural blueprint. Now that we have the foundation, it's time to build the structure. In investing, this means choosing a philosophy. The landscape is dominated by two primary, time tested approaches: value investing and growth investing. Value investing is all about patience and research. It's the strategic approach of identifying stocks that are trading for less than their true or intrinsic value. You are essentially looking for a bargain. The goal is to buy an asset for less than its worth, with a margin of safety to protect you from unexpected downturns. Value investors use metrics like price to earnings and price to book ratio to identify these opportunities. They are not concerned with market hype, they are concerned with the company's fundamental like its revenue, earnings and cash flow. In contrast, growth investor is less concerned with the current price and more focused on a company's future potential. Growth investors look for newer, innovative business with above average growth in revenue and earnings. While this can lead to massive multi-bagger returns, it also comes with higher valuation and great volatility. The most successful investors like Motilal Oswal, Ramdev Agrawal don't rigidly stick to one philosophy. They often use a hybrid model. In India, a popular approach is the QGLP strategy. Q is for quality, a strong business with a clean balance sheet. J is for growth, a business with multi-year earning potential. L is for longevity, a business with a sustainable competitive advantage. And P is for price, being disciplined about the price you pay. This nuanced approach helps you avoid the pitfalls of both strategies. Buying a stock that's cheap for a reason, value trap, or overpaying for a stock that may sustain its growth. In today's data rich world, a modern and powerful approach to investing is a quantitative or systematic one. This means using mathematical models and algorithm to build your decision, thereby minimizing the risk of emotional bias. For beginners, two simple rule-based strategies are highly effective. Momentum strategies involve investing in assets that show strong short-term positive trend. A common way to identify momentum is by using technical indicators like a 50-day moving average crossing over a 200-day moving average. Mean reversion strategies are based on the principle that a stock's price, when stretched too far from its historical average, will eventually return to it. This strategy forces you to buy when a stock is out of favor, which is exactly when herd behavior would tell you what to do the opposite. A critical step in any quantitative strategy is backtesting, which involves applying your model to historical data to see how it would have performed. You can do this with simple tools like Excel or more advanced programming languages like Python. The true power of this approach is that it forces you to rely on a predefined set of rules, not your gut feelings. As one expert noted, a data-driven approach allows you to not predict but respond, which is a far more resilient strategy. Let's talk about the practical framework. With our mindset and strategy in place, let's get down to the numbers. The journey to a 100 crore corpus is a function of four variables: initial capital, monthly contribution, time, and your rate of return. This table, based on common market return target, show how powerful these variables are. For an investor with a 1 crore lump sum, a consistent monthly SIP of 1.5 lakh reduces the time to reach the goal by 9 years at a 12% CAGR. The numbers are clear. Consistent investment, no matter how small, is a non-negotiable part of that journey. Now let's talk about the regulatory environment, because no plan is complete without it. The Securities and Exchange Board of India, or SEBI, is the primary regulator for the Indian securities market. Its job is to protect investors, promote market development, and ensure integrity. SEBI has quasi-legislative quasi-judicial, and quasi-executive powers, allowing it to enforce regulation and penalize wrongdoings. For example, SEBI recently settled a case with the National Stock Exchange (NSE) for 40 crore over governance lapse, which include the sharing of confidential data with a third party vendor without a proper contract. This is clear example of SEBI's role in ensuring a fair and transparent market for all. You also need to understand the tax laws. The Union Budget 2024 brought a uniform long-term capital (LTCG) tax of 12.5% on all assets, up from the previous 10% for equity. The tax exemptions on listed equity and equity mutual fund was also increased from 1 lakh to 1.25 lakh per year. Short-term capital gain (STCG) tax on certain assets was also increased to 20%. Understanding these rules is essential for tax efficient planning and maximizing your long-term returns. Now let's talk about conquering the human variables. We have covered the numbers and the rules. Now let's talk about the biggest threat to your investment journey. Your own psychology. Behavior finance shows us that psychological bias can lead to irrational financial decisions with costly consequences. There are four common biases to watch for. Loss aversion. We feel the pain of a loss far more accurately than the pleasure of an equivalent gain. This can lead to panic selling during a market downturn, locking in losses and missing out on rebound. Herd behavior (FOMO). The fear of missing out can cause you to mimic the crowd, often leading to buying at market peak and selling at lows. Overconfidence. We often overestimate our ability to predict the market, leading to excessive risk taking. As a result, you might diminish warning signs and ignore contradictory information. So, to overcome this, there should be a process in place which we talked earlier. We should stick to our process. Confirmational bias. The tendency to only seek out information that confirms what you already believe. This can cause you to hold on to a losing investment for far too long. So whatever stock we have bought, we should not take only its positives. We should look at its negatives also and not get biased to it. We should sell it not performing well. The best antidote to this bias is a rule-based, objective and systematic plan. Another critical strategy to combat risk is diversification. It's often called the only free lunch in investing. Diversification means spreading your capital across different asset classes, stocks, bonds, real estate, etc. to ensure that the underperformance of any one asset don't derail your entire portfolio. A common pitfall for many retail investors is the tendency to put all their money into a handful of stocks, often based on tips or media hype. This is called over-concentration and it exposes your entire portfolio to a singular risk. The mature approach is to move beyond a handful of stocks and build a truly diversified portfolio. For those with an already large corpus on their way to 100 crore, this strategy evolved to include more sophisticated instruments like alternative investment funds, AIFs, and even direct investment in startups and venture capital. This is the kind of advanced portfolio management strategy employed by many family offices and sophisticated investors, and it's where you will find true diversification and long-term growth. The journey to a 100 crore portfolio is a marathon, not a sprint. It is a long-term project that requires patience, discipline, and a sound strategy. The most successful investors are not the one who predict the market next move. They are the one who puts a solid plan in place, stay consistent, and let the magic of compounding do its work. It begins with a mindset shift, a commitment to live below your means, and the discipline to invest the difference. month after month, year after year. If you want to build a legacy, the time to start is now. Thank you for watching. If you find this video helpful, please subscribe and share with someone who needs to hear this message. Until next time, happy investing. Thank you and Jai Hind.